the CEO and Chief Investment Officer at U.S. Global Investors. Frank, thanks for joining us again today.
It's good to be here.
Frank, you recently spoke at the Vancouver Resource Investment Conference in January. You talked about the Purchasing Managers Index and its impacts on the resources and commodities markets. Can you elaborate a little bit on that topic for us?
Sure. I've been writing about it for a long time. What we try to educate investors on, there's macro themes to get the macro understanding. And we always like to take government policy and bifurcate it, monetary or fiscal, and then separate the monetary and then separate the fiscal, and look for tools that help you forecast. Most people focus on GDP, and GDP is like looking out your rearview mirror of your car. You can't drive quickly staring out your rearview mirror. You have to be looking forward. PMI stands for Purchasing Manufacturers Index. It's a precursor for demand or slowing demand in the next 6 months. And what's good about that tool is that it's a good high correlation to commodity demands for oil, for copper, for metals. And so with that, we try to use it to understand how much cash we should have in our portfolios.
And what is China's role in the delivery of Purchasing Manufacturers Index?
China is significant because they consume between 30% and 60% of all the world's commodities. So I think it's so critical when you look at the data points, and we do the 20-year regressional studies. And what we look at is the 1 month versus the 3 months. And what's wonderful about this is you can take the collection of the world together called the global PMI, and then you can take out the 4 big horses. I like to call Europe, America, Japan, and China. And you've got to have those 4 where they're above 50, and the 1 month's above the 3 months. And if you go back from 2002 to 2007, most of the time they were above. And that led to this huge demand for commodities because there was global economic activity.
So PMI is linked to the country's greatest export or the country's greatest commodity?
Well, it could be both. It could be with their manufacturing. Mm-hmm. So whatever you're manufacturing, if you got an order for 1 million motors, then you're going to have a big demand for copper and for metals, and you're going to use a lot of energy to make these motors. And the other thing is that the higher paying jobs are with the manufacturing sector. So that's why it's important to follow that.
We've seen recent economic data coming from China. Economic growth is slowing considerably. Not a huge surprise. How concerned should investors be at the moment?
Well, if you're in the commodity business, you have to be very concerned. And if you're in, exporting any high-end products, you have to ask, are they going to still be using them? But I think what's really important to look at China is that there's a big push for the service economy. They're building out 25,000 kilometers of high-speed rail, going 300 kilometers an hour. It's 100 and almost 90 miles an hour. And that's incredible. And I've been there. I've taken my board from Shanghai to Beijing. With that, Starbucks is saying they're going to open 70 new stores. So there's great activity when you look at the Starbucks of the world and the service PMI, what they call the sort of similar forecasting. The service industry in China is growing rapidly.
Well, Frank, we've talked about gold often when you've come in. Gold has actually performed fairly well of late, certainly in the first month of the year. Do you see this continuing as a trend?
Well, there's lots of good questions because gold last year did the same thing. And historically, gold puts on an incredible January run, and it's into the Chinese New Year. And if you looked at seasonal patterns going back 30 years, gold has a surge to the Chinese New Year, sells off, rallies again, and you get this surge, the next bottom takes place in the summer. When I look at my quant models, gold is actually starting to overextend itself over the past 60 trading days. It's up 1.8 standard deviations. And so I think that that's something that can easily correct. But what's different than, say, a year ago, which the same surge, and this is that you have Japan going to minus basis points for money market funds. Europe is negative interest rates. So whenever the world is minus negative interest rates, gold starts to perform as an attractive asset class. When gold hit 1900, the 10-year U.S. government bond was minus 3% on your money. So if you bought that bond, you locked in losing 3% a year. That's why gold hit 1900. Then the bonds went to plus 2%. Mm-hmm. So whenever you see real interest rates, and that's the magic, what is the direction of real interest rates in Canada versus the U.S.? So there are opportunities in gold equities, but one has to appreciate the currency and the country where they are producing the gold.
So what does that mean then for perhaps junior miners in Canada or in Australia in the gold sector? Should we expect to see, more takeovers or perhaps higher share prices?
I think you get takeovers of the producers, the small producers. I don't think the explorers, they've got a long way to go. I don't think that you're going to see big mergers in that junior space like we had in 2004 or 5, people just buying reserves. I think that's down there. But if you're a producer, and you're a producer in Canada, and you have a good structure, you can be bought.
Frank, outside of the gold space or broadening from the gold space, are there any companies or any stocks that you like at this time?
For bigger liquid names, I've always been very confident in the management of Franco-Nevada. They have their cost structures in Canada. They have royalties, so it's basically right off the top, so they don't have a lot of the people headaches and government headaches of building out a mine in countries. They have high cash flow returns on invested capital. Their balance sheet is beautiful, and they've been increasing their dividend, and management owns a big slug of the company. So someone looking for a great company, it'd be like, Frank, why would you buy Franco-Nevada versus buying Barrick and Newmont? Well, you just get the royalties. You know, they get revenue is $15 million per employee. 15 million, and Goldman Sachs is $1 million. So you're talking about a very group of incredibly intellectual collection of intellectual capital, like you would have technology in Silicon Valley.
Frank, what's on the agenda for yourself and U.S. global investors this year?
Well, the formation of capital is changing quickly in America, much faster than here. And you're seeing the push for ETFs and the push for what's called smart beta. You look for the 3 to 5 key factors for picking a group of stocks or bonds in a specific industry or category. And they outperform 80% of the portfolio managers. So I think the ETFs are going to really, truly morph the mutual fund model.
Well, Frank, thanks again for sharing your insights. It's always nice to have you with us.
It's great to be here.
And for more expert interviews, analyst insights, and companies to watch, be sure to sign up for our newsletter. For Small Cap Power, I'm Angela Harmantis.